Washington has come to the rescue of the failing banks within Silicon Valley. But what about the everyday person who are not billionaires? I'm Tyrone Bowman. This is Tyrone Bowman Tonight. According to the Washington Post, Washington's bank rescue fails to erase all doubts. On Wall Street, bank stocks were ravaged, with regional institutions hit hardest. Washington's banking rescue had a rocky start on Wall Street this Monday, as the government's response to the collapse of Silicon Valley Bank failed to quell doubts about the health of some mid-sized banks and left investors debating whether the Federal Reserve would be forced to change course in its fight against inflation. The day began with President Biden at the White House seeking to calm fears of a banking crisis before leaving Washington for a California swing. Americans can have confidence that the banking system is safe. Your deposit will be there when you need them, the president said in mid-morning remarks from the Roosevelt Room. In Silicon Valley, relieved customers lined up outside SVB branches to withdraw funds they had feared would be lost. Depositors at the bank's Menlo Park location said they waited up to 2 hours to get their money in cashier's checks. The only evidence of the failed bank's new owners was a Federal Deposit Insurance Corporation news release taped to the door. On Wall Street, bank stocks were ravaged, with regional institutions hit hardest. First, Republic Bank, another mid-sized bank, saw its share price fall nearly 80% before ending the day down 62%. The plunge came despite word that the bank had shored up its balance sheet with a capital infusion from J.P. Morgan Chase. Even some of the nation's largest and best protected banks were shunned. Shares of Citigroup lost more than 7%, while Wells Fargo fell 6%. Broader stock markets were flat. Payrolls are being met in Silicon Valley. There aren't massive overflows or there aren't massive outflows that we can see. So I think that means it has been reasonably successful, said Lawrence Summers, a former Treasurer Secretary. But the financial system suffered a shock, and while the emergency room physicians have done a good job, the patient is not back to full health. While the market response was noteworthy, failing stock prices pose no immediate threat to the banks, so long as depositor withdrawals remain at customary levels. Healthy banks can continue to operate even as their share prices are great, said Karen Petru, managing partner of Federal Financial Analytics, a Washington consultancy. Bank health is determined by the amount of capital they hold in reserve to absorb losses and the adequacy of their available assets to meet any depositor withdrawals. Banks don't live or die based on what the stock price is, she said. Still, the appearance of cracks in the nation's regional banks has caused an extraordinary turnabout in financial Still, the appearance of cracks in the nation's regional banks has caused an extraordinary turnabout in financial conditions that has triggered a swift change in investor expectations of Fed interest rate actions. Less than 1 week ago, Fed Chair Jerome H. Powell need to go higher than the central bank had expected to bring inflation under control. That's what he said. Wall Street analysts expected the Fed to raise rates by up to 0.5 percentage point at its next meeting March 22nd, and warned that the Fed's benchmark lending rate could go as high as 6% from the current target of 4.5% to 4.75%. Now, 40% of investors expect the Fed to leave its rates untouched and to start cutting them by midsummer, according to the CME Fed Watch tool, which is based on futures prices. The government is expected to release the next consumer price index reading Tuesday. If inflation remains stubbornly high, the Fed will be caught between its anti-inflation mandate and its need to maintain financial stability. Goldman Sachs late Sunday said it expects the Fed to pause its year-long campaign of rate increases. Fed officials are likely to prioritize financial stability for now. viewing it as the immediate problem and high inflation as a medium-term problem. The firm's economics said, or the phone's economist said in a research note, evidence that investors were increasingly skeptical that the Fed will be able to continue raising rates also could be seen in the rush to buy government securities. Investors bought so many two-year Treasury securities that the yield plunged below 4% on Monday from more than 5% last Wednesday. The sharpest three-day plummet since the 1987 market crash. Authorities' remarkable Sunday intervention to safeguard the banking system followed days of mounting concern that the troubles at SVB, the favored bank of tech entrepreneurs and venture capitalists, would spread to other institutions, ruling that the failure of SVB and a second trouble lender, Signature Bank of New York, posed a systemic risk to the economy's financial plumbing. Federal officials closed both banks, guaranteed the deposits beyond the $250,000 statutory limit, and removed their management teams. At the same time, the Fed established a new lending program to allow any other bank to obtain unlimited loans by pledging as collateral assets such as Treasury securities. The effort is designed to address problems many banks have been facing as a result of the Fed's interest rate increase and their own investment choices. Unlike its normal banking lending, the Fed will make loans for up to 1 year and will value the pledged securities at their original value, rather than their depressed market price. Banks at the end of last year had $620 billion in unrealized losses on such securities, which saw their value erode as the Fed raised interest rates. Authorities intend to eliminate any doubt about the safety of depositors' funds, but several regional banks, including Pacific Western Bank in California and Zions Bank in Utah, remain the focus of scrutiny and speculation. Investors worry that some banks might share SVB's reliance upon a narrow depositor base and assets that have lost value during the past year of rising interest rates. First Republic said Sunday that it had more than $70 billion in liquid funds after its recent infusion from J.P. Morgan. In a joint statement, the bank's chairman, Jim Herbert, and chief executive Mike Roffler said, First Republic's capital and liquidity positions are very strong, and its capital remains well above the regulatory threshold for well-capitalized banks. In January, the companies report strong financial rates with $1.7 billion in profits on revenue of $5.9 billion. On Capitol Hill, the administration's action won backing from the Republican chairman of the House Financial Services Committee. The Fed and FDIC have taken the right approach, and they've used their powers in a way that is appropriate. Representative Patrick T. Mahenry, a Republican from North Carolina, said in an interview, I think we have a financial system that is equipped to deal with this, and it is my hope that the actions by the FDIC and Fed will calm this current storm. On Monday, the plan also drew a qualified endorsement from S&P Global Ratings, which called the Fed initiative robust and said it should reduce the odds that unmanageable deposit outflows spread widely. But the ratings agency cautioned that it remained unclear how depositors would respond. The jury's still out, said Mark Chandler, chief market strategist at Bannockburn Global Forex in New York. I don't know if it stops the run. In Wall Street, computer chat rooms traders are debating the need for the government to do more. If additional banks suffer deposit runs, the government may need to explicitly guarantee all uninsured deposits in the banking system, some have said, according to Chandler. In 2008, the FDIC did just that under its temporary account guaranteed program, a measure that remained in force through 2012. The administration's approach did not mollify all lawmakers. In the days before its intervention, The U.S. government received an offer to buy the embattled Silicon Valley Bank, according to Senator Bill Hagerty, a Republican from Tennessee, a member of the Chamber's Banking Committee, who said he learned about the matter at an FDIC briefing Monday afternoon. Hagerty said he did not know the bidder, but he said that's evidently they turned the offer down in the hopes of getting something better later. The FDIC declined to comment on the situation. The Wall Street Journal, citing people familiar with the matter, reported Monday that regulators were planning to make a second attempt to find a buyer for SVB. Other lawmakers separately said they had pressed the government in recent days for information about the auction, though regulators remained tight-lipped. What we should have seen is a properly run auction process. Instead, what they did was hijack the systemic risk exception, Hagerty said, noting that the burden could fall on local banks, which in some cases are taxpayers and may owe more in fees. Well, there's no surprise there, is it? As officials reiterated that the financial system remained sound, some banking industry veterans were reasonably confident about navigating the storm. Things will be bumpy for a couple of days, said Bert Eli, a banking consultant, then assuming there are no new disruptions, things will calm down. I'm Tyrone Bowman. Never surrender. Never quit.